Welcome to the 2022 Economic Depression and Preparation channel. I'm your host, Tony. Thank you for joining me on this Sunday, November 13th, 2022 edition. Please be sure to subscribe for the latest financial news in the U.S. and sometimes abroad. I read all of your comments. I thank you for your support. And today, ladies and gentlemen, we're going to be talking about two key issues. There's a 98% chance of a global recession. Some believe that the U.S. and the U.K. are already in recession, and you would be correct. But there's a 98% chance of a global recession affecting a lot of different countries and a lot of different players as we head into winter of 2022-2023. So winter is coming for a lot of us, and so we have to stay prepared as best we can. We're also going to talk about the UK being on the brink of recession. We're going to be talking about the wage inequality gap between wage and income in the U.S. and in other countries, but it's highest in the U.S. And also we're going to touch on the inflation rate very briefly here, being above 7% and elevated most of this year, despite the 50, 75 basis point rate hikes that we've experienced. So far this year, we've already had about 5 rate hikes, and it hasn't done much to lower this rate. Remember, the Federal Reserve's goal was a 2% inflation. We're at 7.75% inflation as of last month. So we're going to get into that. Thank you for your support. Let's get right into it right now. So according to CNNbusiness.com, this was a month ago or a month and a half ago, there's a 98% chance of a global recession. Now, many of us knew that the recession was coming in as we saw that the inflation was not taming itself despite the Federal Reserve's rate hikes. But we did not know the wild cards, the black swans in the event, like the war in Ukraine, for example, lasting this long. It's almost been a year now since we've been into the Ukraine conflict. Not just that, but there's also other conflicts. The conflict we couldn't have foreseen, the conflict of China's economy coming down, having to slow down with the manufacturing and clothes because of more concerns with the bird flu outbreak thing. We also couldn't foresee that this economy would be stuck in a cycle of high prices and stagnant wages, despite the number of job openings that we've seen. You know, you see these signs everywhere you look. I'm sure you've seen it too. Job openings everywhere you look, in terms of jobs going, 60,000 jobs openings here. And every month they say that there's job openings mostly in retail, hospitality, travel, transportation, and some tech jobs as well has been opening up these last few months. That has been the bright spot of this economy. But 7 out of 10 economists surveyed by the World Economic Forum in Switzerland consider global recession at least somewhat likely. Economists dial back their forecast for growth and expect inflation-adjusted wages to keep falling for the rest of the year and next. And this is the issue. Wages are not going to be able to keep up with the inflation because private companies, public companies, they cannot afford to pay their employees higher salaries to keep up with inflation because the cost of production inputs continue to rise on a day-to-day basis. And as diesel fuel continues to rise, you guys know that ladies and gentlemen, the average price of gas in the U.S. according to AAA is above $4 a gallon now. Some states are already at $5 or $6 a gallon like California, as you know. So because of diesel going up that high, these goods and services are not going to be able to come that much at all. And so the UK is on the brink of recession after the economy contracts by 0.2% in the third quarter. This is a sign of things to come here. Bank of England, they're raising rates too, like we are. The European Central Bank, they're raising rates. The Bank of Japan, the Bank of Germany, the Bank of Australia, all these banks are raising rates, interest rates. But you notice that the stores are closing down, and even virtual stores are closing down, virtual fronts. As you know, in Miami, they had the naming rights to the stadium there, or the arena there, FTX Arena, the crypto arena there. And as you know, they went bankruptcy, and that name is coming off. So stores are closing virtually in these cities, from Chicago to Miami to New York to DC to LA to all of these cities, Seattle. Stores are closing down in the downtowns, the suburbs, the hinterlands, and this is going to affect consumer spending. It's going to affect our spending, our discretionary income, as you know. So as we continue to face this, London is a preview of things to come here. We're going to have stagnant wages, high prices, high inflation, and the growth inequality. The U.S. inequality is growing around the world. The rich are getting richer. Same old song and dance that you've heard before, thanks to, quote, large capital gains and favorable tax breaks. Now, let me be clear here. I'm not against being rich or rich people living off the interest of the money in the bank accounts and stocks, investments, etc., PMs or assets. But it is clear that the growth inequality is growing tremendously, not just in the U.S., but the U.S. is leading and across the world. Here's a picture of Elon Musk. As you know, he's the richest man in the world. He just bought Twitter. And so what's happening here is that 70% of the wealth is only owned by the top 10% of people and top 10 richest households in America. And it used to be a time that when the Federal Reserve was created back in 1913, 1916, somewhere around that time frame, and we had the antitrust laws and the anti-monopoly laws, that the companies work for the people, that they were interested in trying to, keep things somewhat balanced. Now we have 7 or 8 rich mega families or mega people owning 80 to 90% of the commerce happening in the States. And I'm sure it's like that in other countries too, in Europe and Australia and China and all these countries. This is what's happening. We have the era of the monopoly, the era of rich people, but not rich nations or rich communities. Okay. And so production has transferred to the hands of a few people, as you can see in the graph here. And income is what's earned, but wealth is what's created over time. And unfortunately, in the United States, we have some people here, as you can see here, 45%, whatever people that earn a high income, but the wealth is not it's just paycheck to paycheck, or it's just something that's been absorbed by the assets that they own, houses, cars, trust, stuff like that, land, stuff like that. So the wealth that's being created is being evaporated back to the top 10%, as you can see in this chart. So because of which, this is one of the signs that happened in the Great Depression in the 1929. Wealth inequality was at its highest, and we're going back in time. History repeats itself, ladies and gentlemen, as you can see with this chart. And so the United States leads the way, as you can see over here by itself. And all these countries, Switzerland, Finland, Germany, France, Poland, they're behind in terms of wealth inequality, but they're still there. It's still there. So the richest 1% of Americans own 34.9% of the country's wealth, while average Americans in the bottom half had only $12,065 less money than their counterparts in the industrialized nations. Okay, so this is another sign of the part of the recession and depression that we're going to be facing. As you can see, this is the live chart. Inflation rate for the U.S. as of October 2022 is at 7.75%. Remember, the goal was at 2% inflation rate. We're not going to be able to achieve that in the next 2 years before the next presidential election. As you know, it's only going to go higher or stagnate because of the interest rate. The pace of the interest rates are too slow. We would need the Fed funds rate to be up above this at 9-10% to combat this inflation at almost 8% right now. That's the issue. So instead of doing this 75 basis points here and there every month, why not just come out and raise it a full 2 points, and see how that happens, how that affects the economy? Because right now we have a situation where the interest rate on credit cards, used cars, even student loans are going up tremendously. Interest rates, of course, the mortgage rate is still above 7% as we speak today. So all of this is hurting all Americans at all income levels except the top 10%. Instead of crushing the inflation, but inflation is not the main problem. The main problem with the top 10% is greed. Once they have gotten the money, as you can see here in the chart, it's only shared between the richest 10% of all households. So they want to keep that power and keep that control. So inflation, in a sense, one of the definitions is equal to greed, because it's created by a problem is created, whether it's some kind of conflict and somewhere in the world where they say, oh, we can't get bananas today, so we have to raise the prices of bananas or raise the prices of grain or whatever. And that's the main issue. So because of corporate greed and corporate buybacks, corporate greed and individual greed, this is one of the issues that we have. And so that's why I continue to recommend that we prepare physically, mentally, spiritually, and emotionally for what's to come, because it's not going to get better. The good news is we have time. We have spiritually and mentally prepared for this. All of you out there have gotten to a place where you know that you're going to be for a while and that you're going to prepare. And that's the good news. And the good news is we still have time, unlike some other countries that have collapsed overnight, like a Greece or a Turkey or Sri Lanka, as you know, so many countries. And it's just coming. The dominoes are coming here to the U.S. soon. The UK is next. And then after a few other countries, the U.S. will be last to collapse in terms of the currency. But after that, it's all bets are off. So continue to stay prayed up. Continue to prepare during this time. Because remember, during the crash of Venezuela and other countries, their stock market, Wall Street, melted up too. So having a strong stock market is not an indicator of a healthy economy. Not anymore. Not in an economy where the fundamentals are not, textbook fundamentals are not being played out as we speak. So be encouraged, be blessed as we start this week. I'll be back with more information on earnings season as we go into the fourth quarter, and I'll talk to you then. God bless. Thank you for listening today.